Hi, accounting class. Today's another great day to do some accounting. Today we're going to cover chapter 4, which is the closing process. Before we do, let's go and just step through the processes here. All the steps in the accounting cycle, there's actually 10 of them. But these actually repeat, or kind of repeat. You see journal entries, post, trial balance. You're going to see the same thing in 3, except just adjusting entries, post, make another trial balance. But after the adjusted trial balance, we actually create the output, the financial statements. That's the first thing we're going to talk about. In the last part, we're going to do the last 3 steps of the accounting process, the closing process, which is closing entries, post them, make another trial balance called a post-closing trial balance. So everything here in blue is what we're going to talk about today. Let's go and get started. We're going to look at the financial statements. Remember, we can build these after we have our adjusted trial balance numbers. So we start with this. So we notice the title to financial statements, whatever the name of the business is first. This is Paws and Claws Incorporated or Services Incorporated. This is an income statement, and an income statement, remember, these are streams of information. So these, you don't earn revenue at a specific point in time, you earn revenue over time. Same thing with expenses, they incur over time. That's why we see the date here being for the month ended, not just January 31st, because we've earned these revenues over the entire month of January and incurred these expenses over the entire month of January. But this is a simple single step income statement, is its name. We're going to see more complicated ones in future chapters, but for now this is all we have. All it does is list out your revenues. So they have 2 types of revenue, so total revenue, and then it lists out all their expenses. They have a lot of expenses. They total up the revenue, they total up the expenses, they subtract the 2, and they get to net income. If this was a loss, i.e. if the expenses were higher than the income, then we'd call this a net loss. But in this case, the revenue is higher than the expenses, so it's net income. Multi-step we don't have to worry about yet. We'll see that in chapter 5. Let's look at the retained earnings statement. Again, the name of the business. This time it's a retained earnings statement. We also see for the month ended because it has things like net income, which is measured over a period of time, and dividends, which are kind of include the whole month of January. So again, we see the same type of date notation for the month ending January 31st. Alright, this just follows our formula. We have beginning balance plus net income minus dividends equals our ending balance. Here they add a subtotal onto the statement where it's an increase or decrease. It's just netting these 2 together. When I say net, it's kind of like adding, but you got to interpret this as a negative number. So it'll be a positive number plus this negative number. Notice how the relationship here, this minus that equals a 5221. The last step is taking the beginning balance, which happens to be 0 because this is a new business. It's their first month of operation. So just like if you just open up a bank account at 0, you haven't deposited anything in it. It's the same concept here. That's why this is 0. But the next month, the beginning balance will be the ending balance of January. So the beginning balance of February would be the ending balance in January. So it wouldn't be, it's not always 0. It's 0 if the business is new. Otherwise, it's the beginning balance. We can see that formula that I'm talking about. Beginning balance plus net income minus dividends equals ending balance of retained earnings. Now let's look at the balance sheet. There's a lot more going on with the balance sheet. Notice the date. It's not for the month ended anymore like it is. These 2 are for the month ended. It's just one date, right? That's because every account on the balance sheet is different than the income statement or the retained earnings statement. Every account here can only be measured at a specific point in time. You can't ask what your cash is during the entire month. I mean, your cash balance changes as you receive paychecks, you pay out cash. So the cash account is changing from day to day. You can't ask what it is for an entire month. You can only measure it at a specific point in time. So all these accounts are as of the end of business day on January 31st. You have your assets, basically you have your accounting equation. Assets equal liabilities plus stockholders' equity. And notice where it gets its name, it balances out. But let's look at, these are current assets. Current assets, if you're writing this down, I'd put less than something that's going to be used up in less than a year. So it includes these: cash, accounts receivable, grooming supplies, basically everything except our fixed assets that we have down here. So all these are our current assets. They're going to be used up within a year, and we can total those up to get total current assets. And we have something called long-term assets or property, plant, and equipment. Fixed assets are another name. Yeah, it's accounting. We have 3 or 4 names for everything. They have our equipment. Notice this equipment's always going to stay on at its cost, back to the cost principle. So this equipment's always going to stay on at cost. It's always going to come on our books and off our books at cost. So if we ever sell it, we'd take it off at 24. But as long as we own the equipment, we use it in our business, it's staying on at 24,000. Notice the accumulated depreciation. This is the account that's going to increase over time. It's going to be 350 per month. So if we looked at the February balance sheet, this would be up to 700. If we did another month, it would be 350 higher. Another month, 350 higher. So this is going to grow over time. And remember, accumulated depreciation is a contra asset. In other words, it's a negative asset. Notice the relationship here. 24,000 minus 350 equals this number. So it's actually a negative number. Negative asset is the way to think about it. And it's always, remember how we said they're basically in a relationship, that any fixed asset and its accumulated depreciation, they always hang out together on the balance sheet. They're always listed right after another. Even if you see it on a trial balance, they're always listed one after another, with the fixed asset being first and its accumulated depreciation being second. We total up the total long-term assets along with the current assets, you get total assets. Same relationship here with current liabilities. Current liabilities are liabilities that are due within 1 year. So you notice they have a lot. Almost all these end in payable. You see the word payable on almost all these. The only one that you got to remember is a liability and not a revenue is unearned revenue. It's a liability, it's not a revenue. It represents when we get paid in advance for goods or service and we haven't yet provided those goods or service. So we owe somebody a good or service, making it a liability. Eventually it will become a revenue. That's why it's kind of named unearned revenue. Whenever we do perform the services or deliver the goods, we'll transfer it out of unearned revenue into an actual revenue account. We total these up. They don't have long-term liabilities. We haven't talked about any. Later we'll get into bonds. Bonds payable would be an example of long-term. We could have long-term notes payable. This one must be a shorter-term one, only a few months. Hopefully I didn't make a mistake and it's not a multi-year one and it's supposed to be a long-term liability. But for now, we're going to pretend it's a short term. Hopefully it is. Alright, stockholders' equity. Just two parts, common stock and retained earnings. Whenever you're doing the homework, pay attention in the instructions. I tell you to place one before the other, and the system will count it wrong if you don't. Even though I wouldn't count it wrong if I was grading it, but maybe I'll find a way to fix it in the future. But just follow the instructions, read the instruction, which one you're supposed to place first. You add those two up, you add up both of these, you get to total, and then it balances out, and that's a balance sheet. We talked about this. A current asset is one that's going to be used up within a year. So things like cash, AR, supplies, prepaid things, as long as we're going to use them up within a year, they're current assets. Assets that are expected to last for more than a year are long-term assets, but again, they have other names. They're also called property, plant, and equipment, or fixed assets. Current liability, same rule. If it's due 1 year, within 1 year it's current. If it's beyond 1 year, it's a long-term liability. Here's the ordering. Assets on the balance sheet are listed in terms of liquidity. So this is actually an interesting concept. These things, liquidity measures how close it is to cash. Of course, cash is cash, so it always wins first place here in this competition. But these other things like accounts receivable, usually the trade cycle, it's usually a month, 2 or 3 months, and it turns into cash, so it's pretty liquid. These supplies, what are we going to use them up in a few months? So maybe we buy supplies for 6 months or so. The insurance and the rent will last for, 3 or 4 months? So they should be in order of liquidity. I.e. how close they are to cash. For some of it's debatable, but it's not debated. Cash is always going to be first under that definition, but AR is usually second, and we have supplies and prepaid usually. Some of it takes some judgment. It would vary from business to business. How long they prepaid for their assets might change its place. So, the order of liabilities is not as structured as that of assets. Some list it in order of their due dates, so how close they are to being due. Some do it in terms of size, so there's not as set and as common of a technique as there are for assets, but assets are definitely in order of liquidity. Here we see the full accounting cycle. We've just covered the financial statements, so the last three right here is next. We're going to do the closing process. Alright, the closing process. At the end of the accounting period, this is usually at the end of the year. So if your year end is December 31st, which we're going to look at, it's December 31st year end to keep it kind of simple. It's the end of the year, so our minds not naturally think it's the end of the accounting period. But keep in mind, businesses can choose whatever month end they want for their fiscal year. A fiscal year is the business year. So you can have businesses that end on any last day of the month. They can end on January 31st, February 28th, March 31st, etc. But we're going with all our examples December 31st, unless stated otherwise. Alright, let's look. This is basically summarizing the whole closing process. we must close all revenue, expense, and dividend accounts to retained earnings. By close, we mean to zero them out. So to close means to zero them out. We're going to close out all revenue, expenses, and dividends to retained earnings. Now, why are we doing this? I think of it like you're playing a game. If you're playing any type of game, you keep score for that game. But at the end of the game, if you're going to play another game, you got to reset the scoreboard, right? So we got to reset the scoreboard so we can keep track of these things for the next year. So these accounts are called temporary accounts. We're going to see this in a bit. All the ones that are closed out, revenue, expenses, and dividends, are temporary accounts. We keep track of them for a year. We close them out to retained earnings. We keep track of them for the next year. We close them out to retained earnings. That's how the accounting here works. So here's an adjusted trial balance, basically our end of the story last time. There's a magic line in here. Let's see. Right here above, basically the second half between dividends and common stock. Everything above this line will be closed out. Everything above it will be closed out, i.e. they're temporary accounts. So everything below that are temporary. Everything above it, notice, are the balance sheet accounts, assets, liability, and equity. Those will not be closed out. Those are permanent accounts. Like our cash. You don't want to close out your cash at the end of the period. You would like to hang on to that. And these other things. If people owe us money at year end, they still owe us money at the beginning of the next year. So we don't close out any of the asset accounts. Those are referred to as permanent accounts, and they will not be closed. Alright, closing entries. We're going to have to think, what's the normal balance of a revenue? Revenue, we should know this by now, has a normal, words acting up, has a normal credit balance. Come on, word. I'm going to show all these. Revenue has a normal debit. It's not there, huh? Revenue has a normal. It got moved down here. That's what happened. So these are the normal balances. In order to close out an account, you have to do the opposite. We're trying to zero it out. So whatever balance it has a credit balance. We want to debit it for its full amount. So this is just going to be the opposite. Instead of debiting the expenses, we're going to credit them to close them. So this is kind of like doing the opposite. We're doing the opposite to close them out. Closed to where? This is simple. They all get closed to retained earnings. So we're going to do this in a three-step process. Basically taking revenues, closing revenue as step 1. This will be step 2, and then dividends will be step 3. And then I'm going to show you a way to do it all in one big journal entry. If we don't like doing multiple journal entries, you can just do it in one big entry. But the net effect is all these should be zeroed out, and their balance should move to retained earnings. If we do that, we've done the closing process correctly. So revenues have a normal credit balance, so we had to close them with a debit. Let's go back and see where our revenues are. We have grooming revenue and veterinarian revenue. Both of these have credit balances. We're going to debit both of these accounts for 100% of their amount to zero them out. So we're going to debit both the revenue accounts for 100% of their value to close them out. After I've done this entry, well, the computer won't take it until I credit something, but assuming it does, these grooming revenue and veterinarian revenue have a zero balance. Retained earnings is where it goes to. So retained earnings gets the offset. In this case, it has to be a credit because of debits and credits. I mean, this is true throughout all of accounting. Computerized systems won't even take your entry unless every number in this column equals the summation of every number in this column. So the balance in each revenue account is now 0. What's the balance in retained earnings represent? So what does this number represent? This number would represent the total revenue, right? Because it's just the addition of the two revenue accounts. So the balance so far in retained earnings represents total revenue. Next step, we need to look at the expenses. Let's go back and look at all of our expenses. We have a lot of them here, so it's a lot to write. All these expenses have a debit balance, so in order to close them, I need to credit each one of the expenses. So I'm going to skip a line. I know I need to debit something, but I'm thinking in my mind I need to credit all of these expenses first to zero them out. That's the objective. And the offset is going to be to retained earnings. So retained earnings will get the debit, and it'll just be for the summation of all the expenses. So important, revenues had a normal credit, so we close them out with a debit. Expenses have a normal debit, so we close them out with a credit. The offset goes to retained earnings. So what's the balance in each expense account after this? 0. We've zeroed out each one of these expense accounts. What does the balance and retained earnings represent after these two entries? Okay, now we need to think. This number represents total revenue and it's a credit. This number represents total expenses and it's a debit. If you netted these two together, we get to the balance of retained earnings. And what happens when you take total revenue minus total expenses? Total revenue minus total expenses. That sounds familiar, right? Isn't that what we did right here? Total revenue minus total expenses get to net income, and we're going to see that same number. If we did it, subtracted them, I mean, it should be the same number. Yes, it is. And it represents net income, because anytime you take revenue minus expenses, it's net income. Alright, step 3 here is close out the dividends. Thankfully, we only have one of those accounts. Dividends here, debit. So in order to close it out, we need to credit the account. So we're going to credit dividends for $2,500. Again, I'm doing the credit first. I know I need to debit something. It's just my mind's going to think I need to zero out the dividends. I do this, credit them for the full amount. I zero them out. And then everything in the closing process goes to retained earnings. Alright, so now we've done the 3 steps. I'm going to show you an optional way to do this. This is one big entry. So it's very similar. We're going to debit all the revenue accounts. So step 1, we had 2 revenues. We're going to debit them. So grooming revenue, veterinarian revenue. Check the step 1 off. We're going to credit all the expenses. Alright. Let me see where I put them. And how many are there? There's a lot of them. 1, 2, 3, 4, 5, 6, 7. 2, 3, 4, 5. There we go. We credited all the expenses. So step 2 is done. We're going to credit the dividends account. And you get all the amounts from the adjusted trial balance. And then we're going to solve for retained earnings. Debits and credits have to equal. So add these 2 numbers up, subtract out all of these numbers, and you'll get the balance to retained earnings. Now it could be on either side. If this business has net income, it should be on the credit side. Or if they actually added to retained earnings, their net income minus their dividends, then it'll be on the credit side. If not, it could potentially be on the debit side. But the math, the debits and credits have to equal 100% of the time. So the total of these 2 numbers minus all these numbers will give us the amount. And if it's negative, just flip it over to the other side. But you have to think of what side's smaller. I think this one had a positive 5221. I'm going to show you where that is on the financial statements. If we go back to the retained earnings statement, there's the 5221. It represents the increase in retained earnings. And since the beginning balance is 0, it's also the ending balance. But you see how everything ties together in accounting? Or it should. Alright, and this is going to be the retained earnings. So you can do this all in one big entry, and this is how computerized systems would probably approach it. Instead of doing it this step-by-step piecemeal, just debit and credit everything you need to. Call it the closing process. Closing entries. Alright, we're going to go through the balance of retained earnings. It starts with the beginning balance. We saw this on the retained earnings statement. Adds net income, subtracts out dividends, and then it reports the increase or decrease to retained earnings if we're doing it for a financial statement. But you don't necessarily need to include this if you're just trying to do the math and figure out the ending balance. After we did that, notice we journalized all the closing entries. We'd post all the closing entries. I put in red all the new entries that we got from this chapter. Notice what happens. Dividends are zeroed out, revenues are zeroed out, expenses are zeroed out. And then a lot happened in retained earnings, right? This is our total revenue. This is our total expenses. And then no, wait, I said it wrong. 26,160 is our total revenue. 18,439 is our total expenses, and 2,500 is our total dividends for the period. It has an ending credit balance or positive balance of 5221, which matches out to the retained earnings statement. Alright, now we get to another trial balance, but you're going to like this trial balance a little bit easier, a little bit better, because it's shorter. It's shorter because it does not contain any revenue, expenses, or dividends. Notice they're all zeroed out. We don't have to put it on a trial balance if its balance is 0. We only have to put things that have a balance, since these are all zeroed out. So we only have certain types of account on here. I'd call them balance sheet accounts, because it's only assets, liability, and equity accounts that are left on here. All the revenue, expenses, and dividends were closed out in the closing process. And the post-closing process trial balance is the last step in the accounting process. So here's the Chapter 4 summary. Basically, these are the 3 different steps. Or just do it all in one big entry. You can figure out the ending balance of retained earnings by taking the beginning balance plus net income minus dividends equals the ending balance. Revenue, expenses, and dividends are temporary accounts. Assets, liability, and equity are permanent accounts. The last step is a post-closing trial balance. And the post-closing trial balance does not include any revenue, expenses, or dividends. It only contains the balance sheet accounts. Alright, that's really it for Chapter 4. Chapter 4 should be, the closing entries are tricky. It's one of the most commonly left blank pages on a test, but to me, I think it's one of the easiest one. There's only a few steps to it. It's a shorter chapter, but it is kind of opposite in nature. But everything just gets closed to retained earnings. I bet a lot of you are going to see this not as bad as maybe Chapter 2 and Chapter 3, but that really concludes it for Chapter 4. See you guys next time for Chapter 5, Merchandising Business. Alright, bye-bye.